As of the market close on Friday, August 7, 2026, Supermicro Computer Inc., trading under the ticker symbol SMCI, closed at $31.13 per share. That represented a minor gain of 17 cents, or roughly 0.55%, on total trading volume of approximately 32.38 million shares. During that final trading session of the week, the equity fluctuated between a low of $29.68 and an intraday high of $31.34. With standard market sessions currently closed for the weekend, that figure stands as the baseline level heading directly into a massive catalyst week. While standard headlines focus on Supermicro Computer as a volatile server provider riding high on AI server demand alongside tech titans tied to NVIDIA stock, the true underlying story here is far more complex than a simple hardware boom. Most market participants assume that Supermicro Computer is merely a leveraged play on enterprise server build-outs, subject to relentless margin compression, component supply chain bottlenecks, and severe institutional skepticism following past financial accounting delays. The consensus belief suggests that because hardware assembly margins are structurally low, the company will inevitably lose market share to larger traditional hardware competitors as the AI build-out reaches saturation. However, the reality hidden beneath recent order flow and revised management figures presents a starkly different narrative. Beneath the noise of daily price swings, Supermicro Computer has been restructuring its underlying product mix toward high-margin rack-scale liquid cooling architecture, positioning itself to capture operational leverage faster than Wall Street models currently reflect. When retail traders check their individual brokerage accounts or scan popular investing sites over the weekend, the surface numbers seem to paint a story of hesitation. The stock has been trapped in a wide consolidation range, oscillating well below its 52-week peak of $58.78 while holding above its 52-week low of $19.48. Yet, institutional volume patterns tell a completely different story. Major market participants trading through platforms like Interactive Brokers and Fidelity Wealth Management accounts have been quietly accumulating shares on pullbacks. The upcoming fiscal fourth quarter earnings release scheduled for August 11, 2026, has turned this stock into one of the most heavily discussed tickers across retail and institutional trading desks. If you track retail positioning on platforms like the Robinhood app or SoFi Active Investing, you will notice a huge contrast in retail sentiment compared to hedge fund positioning. Retail investors using Robinhood stock trading or SoFi Active Investing often focus heavily on daily volatility, treating the stock like a speculative option play. Meanwhile, institutions utilizing Interactive Brokers trading tools and Fidelity brokerage options are closely evaluating gross margin revisions. Wall Street analysts previously projected gross margins to languish in the single digits, expecting figures around 8.2% to 8.4%. Yet recent management updates surprised the street by forecasting adjusted gross margins rising into the 15 to 17% range due to superior customer mix and higher margin data center infrastructure products. This gap between expectations and reality is where the biggest market mispricings happen. Wall Street expected margin decay from aggressive price competition, but reality showed product mix enrichment from complete liquid-cooled server racks. When a company transitions from selling individual server chassis to delivering fully integrated plug-and-play data center modules, its average selling price jumps dramatically and its margin profile shifts from low-margin manufacturing to high-value infrastructure integration. To understand how we got to this exact moment, it helps to examine the broader market context affecting tech equities like Apple stock, Tesla stock, and semiconductor leaders. Over the past several quarters, investor sentiment across self-investing portfolios and automated services like Schwab Intelligent Portfolios, where the SoFi robo-advisor, has been heavily dictated by corporate capital expenditure plans. Big tech firms are spending hundreds of billions of dollars constructing massive AI clusters. However, building out data centers is no longer just about buying chips. Power density limits and heat output have created a massive bottleneck for modern data centers. That is precisely where Supermicro computers steps in. Before expanding further into the forward-looking catalysts and potential downside risks, let us look briefly at what the company actually does and how its core operational structure operates. Founded in the early 1990s and based in Silicon Valley, Supermicro Computer builds high-performance server and storage solutions based on modular architecture, known internally as data center building block solutions. Rather than offering rigid off-the-shelf systems, the firm builds customized rack configurations tailored to specific enterprise requirements, supporting high-density compute applications, cloud infrastructure, edge computing, and artificial intelligence workloads. By maintaining close relationships with primary silicon manufacturers, the company historically gets new processor architectures to market faster than traditional enterprise server vendors. Over past reporting periods, Supermicro Computer demonstrated astronomical top-line revenue growth, scaling sales from under $2 billion annually to over $10 billion in single quarters. However, rapid scaling brought operational growing pains, including intense working capital requirements, supply chain delays for specialized liquid cooling components, and intense regulatory scrutiny regarding financial reporting timelines. Those operational hurdles created severe price drawdowns, pushing the stock down from historical highs and creating the deep sentiment divide we observe today. Now let's focus back on the immediate price action and trading mechanics ahead of the August 11th earnings release. In the options market and across major online investing platforms, implied volatility for SMCI options has spiked significantly. Traders using the Fidelity mobile app or Robinhood fractional shares features are bracing for a double-digit percentage price move once numbers drop. Consensus sales estimates sit around $11 billion, representing a massive 91% year-over-year top-line gain, while non-GAAP earnings per share expectations hover between 65 cents and 70 cents. Comment below how many shares of Supermicro Computer you currently hold in your portfolio, or tell us if you are waiting on the sidelines for post-earnings clarity before putting capital to work. When analyzing the volume metrics over recent sessions, trading activity on the Interactive Brokers platform and Fidelity trading platform indicates that institutional funds are split into two distinct camps. The bearish thesis relies on persistent risks regarding cash flow generation, inventory holding costs, and fierce competition from legacy server giants who are aggressively discounting enterprise hardware. Bearish analysts argue that even if revenue grows rapidly, the capital intensity required to build and hold massive inventory buffers will consume operating cash flow, limiting shareholder returns. Conversely, the bullish thesis argues that market participants are underestimating the structural shift toward direct liquid cooling technology. Traditional air-cooled server racks struggle to handle the thermal output of modern high-performance chips. Supermicro Computer's early investments in liquid-cooled rack engineering give it a massive time-to-market advantage over competitors. If liquid cooling adoption accelerates from single-digit percentages across global data centers toward 50% over the coming years, Supermicro Computer stands to capture a lion's share of that build-out, driving sustained margin expansion that far exceeds historical consensus models. For investors managing their own capital through an individual brokerage or exploring online investment opportunities, evaluating this risk-reward ratio requires looking beyond surface-level quarterly noise. If you utilize intelligent portfolio tools, SoFi ETFs, or holding individual stocks within Fidelity IRAs, understanding how macro liquidity flows interact with high-beta hardware stocks is essential. Rising interest rates or sustained component shortages could put pressure on short-term valuation multiples, whereas stable component supply and robust hyperscaler orders provide immediate upside fuel. In summary, the ongoing tension in Supermicro computer stock reflects a classic battle between past market expectations and emerging operational realities. The market expected a commoditized server vendor burdened by accounting overhangs and razor-thin gross margins. The developing reality shows a specialized data center infrastructure vendor achieving gross margin recovery through advanced liquid cooling systems, strong top-line execution, and deep integration with leading chip manufacturers. As we head into the August 11th financial report, whether reality continues to outpace expectations will dictate whether SMCI breaks out of its multi-month consolidation pattern or tests lower technical support levels. Maintaining a clear perspective on actual fundamental execution rather than emotional headline reactions remains the single best strategy for navigating this stock moving forward. Disclaimer: this video is made only for educational and informational purposes. I am not a financial advisor. Any stock, crypto, or investment discussed here is not financial advice. Please do your own research or consult a qualified financial advisor before making any investment decisions. Invest responsibly.